Thinking of starting a limited company? Well, this video is for you. As a business accountant, my team and I spend all day long helping small business owners on their journey. And as a course, the most common question we get asked is this idea of should I be a limited company or not? And as we approach the end of 2024 at the time recording this video, a lot of people are always interested in this topic because they're thinking of starting new ventures for 2025, or they've just come off their holiday and they're looking for it. And I've seen an increase in it. And I thought, do you know what? We need to do an updated video talking about this because the old one's a bit old now and a lot has changed. Most of the concepts in that original video still exist, so if you've watched that, this is still worth a look just to kind of recap. And what I want to do here is talk about the good and the bad, the pros and the cons of having a limited company. And then at the end, I just want to talk about a part where it's like, well, what's the common scenarios we see where it's a good idea to be a limited company? And what I'm hoping is also to stop you instantly thinking the limited company is always the right answer, because it definitely isn't. And every year we see people coming to us at the last minute wanting a limited company done. We're really keen to help them, but then they realise what it's going to cost in terms of just getting all these things filed, which we're going to talk about. And then it's a case of, oh, maybe I shouldn't have been a limited company from the beginning. So I'm going to help you with all of that in this one. A lot to cover, so let's get straight into it. But before we do, if you do like these videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. Now, I think it's worth just saying in general, and I'm going to use the words generally, usually, typically a lot in the video. And the reason being is that it's very specific to your circumstance as to whether it's a good idea to be a limited company, but there are real key themes. I know particularly if you're a really clued up person in tax, or you're an accountant or somebody watching this video, which we do get a lot of that, you're probably thinking, oh, well, actually, in this instance, that's not true. But this is why I like to say is generically, we're talking generically here. So always get tailored advice if you really want to know the answer. But I think there's a lot of key themes we can just help you and educate you with here that you need to know about. So that's the first one. I also think it's worth recapping that limited companies come in all shapes and sizes. So we've got everything from a small cake stall right up to, multi-million pound manufacturers. And so limited companies are on a wide spectrum. It's not like you need to be a certain size to be one. It's very common these days to be like a one-person freelance, say, copywriter or something like that, and have a limited company. That's completely fine. But let's talk about whether it's a good idea or not. So let's talk about the good then. What is the good aspects of being a limited company? Well, the first one is this idea that you're a separate legal entity. If you've been to school or college and done business studies, this is one of the key concepts they teach you, is this idea that actually the company sits over here on its own. So legally it's its own thing. If you sue it, you're suing it, not the owners and the directors. So for that reason, the legal protection it offers in limited liability is quite appealing. Now, it's not bulletproof in terms of if you go for small business lending, quite often you'll be asked to sign something called a PG, a personal guarantee, that lets the bank see through the limited company and look at your assets, so your house or whatever else that you might own if you start to default on the loan. But for the majority of things, like if you started to employ a team or you got into problems with taxes, generally the limited company is just going to have to go into liquidation or fold. You see it all the time on the news, and that means that your personal assets are protected. So we often see that in various different places in people's business journey, that becomes more attractive. So it's very common to see a situation where a sole trader has then needed to become VAT registered and or wants to get a team, and it makes complete sense then to think about limited company for this legal liability sort of limit on its own. So that's there. Obviously there is insurance and other things that you can take out, but I think for a lot of people that's quite key. And on top of that, I think this idea that the business looks better, it looks more professional to have a limited company, it's searchable on Companies House. We can talk about whether that's a good thing or not later, but ultimately it gives you that feeling that actually it's a bit of a tangible thing. You're a director of a limited company, you're normally the owner as well, the shareholder, so it's good. People love using CEO on their titles if they want to. I'm not sure about that, but I think that, yeah, it just adds a bit of gravitas to the situation, so that's quite big. And you can argue that with VAT registration. We're not talking about that in this particular video. There are some other videos on that, but VAT can often have that feeling as well, this bigger business. Now, there can be scenarios, though, where you're forced into it commercially. We could talk about that at the end, where you might need a limited company because of the way you want to operate with a certain client or something like that. But in the point where you've got a choice, this limited liability and this feeling of being a bigger business are all things that people desire, and that can be one of the number one reasons to actually want a limited company in the first place is all those things. But as I said, you can be forced into it because actually right at the beginning, let's say you're going to go and do some sort of business where you're reselling through an online platform, you might be asked for limited company data and it feels like that's the only way you can operate. So sometimes that kind of forces your hand. Now, of course, as accountants and tax people, saving tax is a key one. And without the history lesson, if we went back quite a few years, the difference between being a limited company and being a sole trader, which is your two main kind of trading types, there are others available, but they're the two that you see most common with a small business, was massive. If you had somebody earning more than about 16 grand, going back many years ago, the limited company would pay a lot less tax combined than the sole trader. So recap of how this works is you both pay tax. The company, as its own legal thing, pays tax. It pays corporation tax. And at the time of recording this video, that corporation tax is somewhere between 19 and 25%. And a sole trader is paying their personal tax, and that's somewhere between 20 and 40 and 45%, depending on what they're earning. So in some circumstances, you can see the rates are cheaper here. But this one has, when you draw the money from the company, you may also pay secondary taxes. You might pay personal tax as well as the company tax. And that sounds odd. You think, well, why does paying tax twice here mean that it's better than this? But it's just the mathematics of it. These two tax rates of personal tax plus corporation tax combined, when done properly, can end up quite often being lower than the national insurance that we haven't talked about and the income tax here. Again, there's loads of different calculations of this, and that's why I say it's quite a big thing in terms of where you are and what you want to do with the money as to whether that's actually a saving or not, but that's why. So in history, that used to be really far apart. But we've had some great news in the last couple of years that national insurance has come down for sole traders and effectively gone up for small business owners in a limited company because of the way the employer's national insurance has worked. It's particularly topical as I'm recording this video because we've had the budget late 2024, which has changed this quite largely. So the two are very close now. But there are still a lot of situations. That's why the vast majority of our clients are limited companies. And it's because there's a lot of tax opportunities here. You also end up in different tax rules. So behind me, there's 22,000 pages of tax law, and you're almost adding another book when you're talking about a limited company because you're looking at employee tax law. And as a result, you have other opportunities, things like trivial benefits. We've done other videos on these, tax efficient perks like mobile phones and things like this you can do that aren't available as a sole trader. But a sole trader is still a really good way of working. There's a lot of flexibility to tax rules there, but that's probably another video. But tax rates. So tax rates are sometimes in the right situation. Historically, they've always been better over here with a limited company, but now they're a lot closer. But in the right circumstances, this one's still going to be better. So for a lot of reasons, tax reasons, that can be good. And I'll explain at the end why in some scenarios that might be the case, because there are some very specific generic scenarios that you can say, yeah, look, that's a good idea for a lot of people in that situation. So tax rates. Now, on top of tax rates, you've also got two things going on. You've got a bit more control in a limited company about when you're taxed. There's some limited things you can do with sole traders, depending on the basis of which you prepare your tax return, to control how you're taxed. And what I mean by that is you can time when you get paid sometimes in a particular method to control what you've got to put on your tax year and what you get taxed in your tax return. But as a limited company, you've got a bit more control because the company itself doesn't have too much control. That works out its profit on paper with all the accounting rules that go with that. And then it pays its tax at 19 to 25% at the time recording. The bit where you're in control is how much do you take out and when. And how you do that really can have a big impact on your tax bill, and that doesn't exist over here as a sole trader. So there's quite a bit of timing that can make a really big difference to the tax saving. So it's not just the rates, it's the control. And then on top of that, there's also quite a large cash flow benefit in the right circumstances as well. So sole traders tend to pay, when they're relatively successful and their tax bill's over £1,000 a year, they'll pay twice a year in something called payments on account. So you pay your whole year's tax, and they want half of that year's tax again up front for next year. Upfront's arguable, but most people would see it that way. And then the other half upfront in the July after you've paid the first lot of tax in the January. So you end up paying this constant big chunks of tax. And as you get more successful, those chunks can be relatively significant. I mean, I've seen a few this week at £8,000 plus. Now, the limited company itself doesn't pay, at small business level, doesn't pay payments on account. So it just pays once a year. So you're holding the cash longer, can be a bit easier to plan for, and there's more cash flow advantages of having the cash. You as an individual, as the owner, the director, so normally you're the shareholder, the owner, and you're the director, you're generally going to take money as dividends, and that will attract a personal tax bill. Now, that personal tax bill does have the payment on accounts problem if you take enough, but it's such a lower proportion of the bill than the main corporation tax bill. So the cash flow of it tends to come out a lot better. So there are cash flow advantages as well. So it's like a combination of factors. It's not as easy as it used to be where it's just rates now. It's a combo of factors, but they are big. So the right circumstances will save tax. Now, in terms of the bad stuff, the cons, the main one is going to be cost. And this is the sad fact of what we do as a job. We love helping small business owners. Obviously, there's a cost attached to that. And what happens is you see a lot of people started up limited companies because in this country, it's super cheap to be able to form limited companies. It's just got more expensive because companies have to put up their fees, but it's still relatively cheap and easy. So people will form limited companies and then they don't really do much with them, or using the cake stand example I gave you, they might do like £500 a year. And then they've got to file all the accounts. So quick recap, there's other videos on this, but you normally have to file a set of accounts with Companies House, a set of accounts with the tax office is really detailed, electronically tagged with a set of corporation tax returns. And then you've got 2 Companies House returns on top of those and with a fee to pay. So all of that is generally done by an accountant. It's not like a personal tax return where there's a free tool from the revenue. There is currently one available, but the current plan is by June 26 to have got rid of that. But it's also only very specific sets of accounts that can be used with that tool, and I'm yet to see somebody actually use it properly, but it does exist, but it's going away. So as a result, that's why nearly every limited company is going to have an accountant, is because on top of that, on top of all the tax rules, you've also got to use all the accounting rules to come up with the right profit. And it's a pain. You know, if you ever seen the accounting rules for how to work out how to depreciate something, or how to work out how to display a loan in the accounts, they're like quite challengingly difficult, and obviously we trained for years to figure this out. So that's why you'd have that done. But as a result, that's quite a bit of work to do. And whether you've done £500 in the cake store example, or you've done £105, the actual base work is going to be the same. So a lot of people will say, well, I haven't done a lot, but it really doesn't matter from a cost perspective in most cases. It starts to matter, like don't get me wrong, a set of accounts for £1 million company is going to be a lot more difficult to do than the £500 example. But at the lower end, there isn't a lot of difference. So as a result, your actual costs can be quite high relative to what you've got in terms of turnover. So that's the biggest one. So I'd say to you, if you're really not sure, then consider the cost implication alone, and also don't leave it to the last minute. We see a lot of people who leave it to the last minute and then need our assistance, which of course we always try and accommodate, but it's always a bit of a dash around. So there's that going on. And then you've also got to keep good records. Now, you have to keep good records regardless, but with the sole trader though, in theory, you could currently just get away with a spreadsheet with you know, a categorized income and expenditure on it, the ins and outs, if you will. That's all changing again, April 26th for that. That's meant to be going digital, making tax digital, but that's another video. But currently that's a bit easier. You don't have to account for every penny. Whereas in a limited company, because of this legal entity idea, it's not your money. Every penny needs to be accounted for. So we'd always say accounting software is the way to go. Make sure that you've got accounting software, a Xero or a QuickBooks, something like that. If you've seen those things being advertised, is a really good start. And you inputting the data on there starts to build this, what's known as a double entry report behind the scenes. And again, it could be a whole video, but just know that it's really important to have access to that. So some of these softwares you see with the banks where they say, oh yeah, use our free software, they're often not creating a full double entry set of accounts, and they're no better than a glorified spreadsheet. So go and look at proper accounting software, but you just know that, yeah, your record keeping is going to need to be a bit more stricter and a bit better, because you've got to account for every penny and balance where it all came from. So that's going to be quite big, and I'd say that's a relative downside, is the fact that you have to keep these extra records. Now, in terms of the last couple of downsides, I'd say one is, we already talked about it, but your data is in the public domain. That means people can search you, they can see you're a director of these companies, and that can cause some people some angst, I know, and they worry about their privacy. That's only going to get worse from the current plans in June 26. TBC on that. We're hoping, we're still going to continue to argue about the changes, but there are some big changes coming in around June 26 with the way companies have to report their data, and it's really not great. So from a privacy point of view for a small business owner. So that is definitely a bigger sort of con, or a bigger bad area than it was when we recorded this video a few years ago. So bear that in mind. If privacy is key to you, you've really got to think about that, because they're not publishing people's tax returns, but they are publishing people's accounts, and they already, your name is attached. So bear that in mind. And if the kind of standard they're talking about is going to end up online as it is, there's going to be a lot of data about your earnings if you're a very small business, and you might not like that. So that's a big one. And the other one, of course, is if you do want to shut them down, there's a lot more hoops to jump through. There's actually a cost, surprise, surprise, companies charge a fee to strike it off. And depending on what you've got in the company, it's not always as easy as just kind of closing the bank account. There's a lot more other things to do. There's time limits revolved around when you can strike it off and how long you've got to not be trading before you can do that. And I think people are surprised sometimes of how long that process takes. So that is the other downside. Obviously, you're going to be really successful, I'm sure, and not need to shut it down, but just know that that can be a challenge. So I did say I'd share a summary then of some of the key points from this in terms of where you would normally see it. So I would say generally, and always seek out professional advice, so generally, people earn an excess profit of around £40,000 tend to see good tax savings versus the extra cost, because you can have the cost of the accountant on top and things like that. If you factor that in, maybe the software, although the software, I think sole traders are even going to have this problem because there is no free software for what's going to be known as making tax digital for income tax. So either way, you're going to have this extra accountancy cost to factor in. So about 40k is good for some kind of cash flow and tax. Certain scenarios, you could definitely still save money on less income. It's just as if that's your sole deal with nothing else going on, that's a very common level we see working quite well. However, if you've got other substantial income from a job, so say you earn 60 grand in one job and you're thinking doing a little side hustle, and you don't want to draw all of that money, so you want to invest it in your pension or something like that, that's a very common way of operating a limited company really well. Because one of the things that limited companies currently do very well at the time of recording is get your money from that company into your pension very tax efficiently. So if you've got a want to do that, to put money into your pension, you don't need it all, then actually a lot less profit levels, that starts to look a lot more attractive. So that's quite common. I think the other one we see is if you could split your income with a significant other who's also in and around the business. So stereotypically, husband and wife business, one of them is doing a bit of admin or some support in the business, has a small shareholding of ownership, and may even not have too much income around the household, so might even have a salary from the business, and the other person's working full time in it. And that can, if you imagine your profits start to get split out using two sets of allowances, starts to become really, really tax efficient. So those scenarios, any combination of those things I just said, is very common to see the sort of the distance between which one's better looking a lot better. But if you're just thinking, I just want to get going in my business, I really don't know, I don't think there's anything wrong for the majority of people with beginning off as a sole trader and just seeing how it goes. There is some considerations, and I think we've done other videos on it when you want to move to a limited company, but they're not massive, and they're definitely very common things to do. And I think if everyone did that, you'd end up with a lot less kind of stress for those owners that booted up a limited company and did nothing with it, or traded it for £1,000 and need full trading accounts just because of that. And as I say, I would absolutely recommend seeking out professional advice if you're really worried about, for your situation, which one is better. Obviously, there are lots of accountants out there, or if you did want to get in contact with my team, details in the comments below. That's it. Hope you've enjoyed this video. Please do share it with anybody you think needs to know the information, and I'll see you in the next one.